Now, the 16th largest bank in the USA has fallen, and it is taking down global stocks, particularly banks down with it in its collapse. On Friday, investors and depositors in the US's 16th largest bank, Silicon Valley Bank, woke up to news that the bank is defaulting and seemingly insolvent, even with billions of dollars in deposits and investors' money. The shock waves have actually been with the collapse of another bank, Signature Bank, which has been taken over by U.S. regulators who have continued to work hard to reassure investors, and this has been felt worldwide as questions are being asked about how tight the regulation market is for banks. Kokkie Kooyman is a veteran banking analyst and co-founder at Denker Capital, and he joins us now to tell us exactly what he thinks this actually means for emerging market banks here in South Africa and others around the world. Kokkie, thank you very much for your time this evening. The U.S. lawmakers are still investigating what led to the collapse of Silicon and Signature banks, but from your 30 years of experience, what is probable about what happened in what should be a highly regulated environment, particularly following the 2008 global financial crisis?
Yeah, no, you are spot on there. In fact, since 2008, especially in the US, but also in Europe, there have been an incredible amount of regulations introduced to make banking more safer, or to prevent a repeat from 2008, where the failure of the banks at that stage almost led to a total collapse of the system. And to a large extent, it has worked, but what went wrong this time was actually started outside the banking sector, and it was really loose monetary policies from central banks, firstly in Europe and like Switzerland, where you had negative interest rates, and what we call then quantitative easing, which pushed a lot of capital and money into the markets. And then post-COVID, in March 2020, the US Federal Reserve did the same thing and really pushed a lot of liquidity into the system. Now, you'll recall that led to technology stocks and crypto coins and Bitcoin becoming very attractive investments, because interest rates were just so low that all this money went into areas like that. And that pushed a lot of money into the banking system as well, in deposits. So much so that the banks, especially the banks in Silicon Valley, and we'll get to that just now, but the two banks that fell over were both very related to Silicon Valley and technical tech startups and crypto. But those banks got so much deposits that they had to invest the excess. They couldn't lend all those deposits out. And they lent out and they invested those in government bonds, which is U.S. government bonds, very safe, no problem. Except government bonds at that stage gave you very low interest rate at 0.8, 0.7%. Thereafter, as the economy in started recovering and inflation became a big problem, the Federal Reserve Bank hiked interest rates significantly, and they are still hiking. The problem that created was that your government bond investments reduces in value. It's almost, think of house prices. If you buy a house when interest rates are 5%, but suddenly interest rates go to 20%, the payment on your house with higher interest rates becomes so high that you can't afford, and house prices fall. That's effectively what happened in the US with government bonds falling. The problem with that is, at the same time, there was a liquidity squeeze because of higher interest rates. The deposits left the banks again. And now suddenly we get to the problem on last week where the banks were forced to, in order to pay those clients their deposits that they were withdrawing, they had to sell government bonds. And those government bonds now were in loss position. So the banks made huge losses on the government bonds that they had to sell. And that then really started worrying investors. And we had a typical bank run where the banks who had very high concentrated and what they call unguaranteed deposits withdrew money from the banks. And now today, in a technological age, that can happen electronically overnight. So your larger depositors in the US banks withdrew their money from specifically Silicon Valley Bank. And that led to, in the end, so much money going out of that bank that the Federal Reserve Bank had to step in and save it. Then depositors got even more worried and started pulling money from Silicon Valley Bank. And again, the Reserve Bank, or the equivalent there in the US, the Federal Reserve Bank had to step in. And what they then did, not only did they close down Signature Bank, but they then actually made a statement that they will stand behind the banks, and it gets a bit technical, but effectively they will guarantee deposits. If you look forward, now, by the way, what the Federal Reserve Bank then, by that doing did, is they actually stabilized the system. They took away the concerns from depositors about the safety of their deposits. And you can see yesterday the market was still very uncertain. Today, most of the banks in the US, especially those that fell a lot, some of them are up 20% today. So yesterday was a good day, if ever, to take your money away from under the mattress and invest it in bank stocks. If you move on to South Africa, then South Africa and other emerging market banks are not really affected, because we never followed the same loose monetary policies. In South Africa and other emerging markets, interest rates have stayed fairly high. We didn't follow quantitative easing policies. So the central banks here, and in South Africa specifically, to protect the value of the rand, we didn't flood the market with liquidity. So our interest rates have remained high. We haven't got the same pool of excess deposits. And so effectively, emerging market banks are not really affected by this whole crisis, and they've actually come through it fairly strong, and in fact could benefit, because what has happened now with the scare in the US, it's unlikely that US interest rates will go much higher, which will lead to a weaker dollar and actually benefit emerging markets. So if anything, for South Africa, we are better off on that score after what's happened over the weekend in America than before.
Hi, Kokkie, that is so reassuring that South Africa is that well off compared to the U.S. But there has been a frenzied sell-off of banking stocks around the world, judging by how bank stocks have been pummeled. And crypto, however, is up. What exactly is happening there? Are investors opting to put their money on crypto all of a sudden?
That's a very good question. A lot of it's to do with timing. Crypto last week, in the first few days, fell dramatically. I think Bitcoin went to as low as 19,000 from, I think, 2 or 3 weeks before, the 25,000. So crypto coming down the whole time on the fear that the US Fed is going to hike interest rates. And with this crisis in the banking side, and especially once the Fed said they will stand behind and guarantee deposits, the crypto investors got confidence that interest rates aren't going to go much higher, that there won't be further withdrawals and selling of crypto to fund other problems. So they started buying crypto again. The bank stocks acted a bit later. And so today, in fact, in the US, bank stocks are up sharply. And I think you'll see the same tomorrow in South Africa and Europe. So a lot of these things happened almost in different time zones. But I think if we stand back at the end of the month, the bank stock should be back to where they started, and crypto should be back. Bitcoin, for example, should be back to where it started the month. But it's been very volatile because of the huge uncertainty created. And then as the Fed stepped in, different markets reacted at different times. But I think in the end it will all come through positive because of the confidence that the Federal Reserve Bank has restored to markets.
Kokkie, before I let you go, from what you're saying, I'm understanding that there is a possibility that the U.S. Federal Reserve could actually hit the pause button. They could actually say, let's not raise interest rates at the next meeting. But what does it mean for locally here at home? We are having the same MPC meeting by the Reserve Bank in 2 weeks' time. Do you think that is going to be a same, put a pause on it, or do you go with those who are saying we should expect a 25 basis point hike for the meeting that is on the 30th of March?
Yeah, I definitely think that the shock of the deposit flight has actually highlighted the negative effects of higher interest rates. And look, by the way, they were too late and too slow, but now the medicine is working. So definitely I would say, with all my experience, I would be very surprised if the Fed hikes 50 basis points in March, which was already started to be expected, and that they could possibly stand back and say, okay, let's see what goes, but maybe they don't want to let the market get too relaxed, and they might hike 25 basis points. South Africa, the same. If the US hikes only 25 basis points, the urgency for us to hike is not so much. The rand is actually strengthening now because of the dollar weakness, so we can afford to pause as well. So I would certainly think that what's happened over the last sort of 3-4 days will pause the hike in interest rates and could actually weaken the dollar, strengthen currencies like the rand, and maybe take the pressure off the Reserve Bank as well. So maybe that's good news for us as well, in that we pause at the next hike.
Kokkie Kooyman, with a bit of good news that he sees in his glass ball there. Thank you very much for your time. He expects that there could be a pause in the U.S. and in South Africa when it comes to interest rates. And of course, Kokkie Kooyman is the co-founder at Denker Capital, someone who is managing hundreds of millions of rands in investments per day. On that note, it's time to take a closer look at how the markets have fared today.